other alternative investments. So we've gone over some main types of investments. So now let's discuss some other alternative investments. The first alternative investment that you may want to take advantage of is an insurance policy on a family member, particularly a parent. Your parent could take out a policy on themselves or have an existing policy where your parent changes the beneficiary to you and then you take over the payments of the premiums. This will cost you up front but could generate a nice return in the end. Now, if you have lots of money and can afford to lose some money, then one of these next three options may be for you. The first of these investments is with a venture capital firm. A venture capital firm is a form of private equity where investors provide funding to small companies or startups with exceptional growth potential, or to companies that have grown quickly and appear poised to continue to expand. Generally, you will see these types of investments with tech companies. Venture capital generally comes from well-off investors, investment banks, and other financial institutions. Though the investment can be risky for investors, the potential for an above-average return is an attractive payoff. Understand, these are highly risky investments as VC firms generally have a lot of failed investments and then hit a grand slam with one. You know, Meta or Facebook was a prime example of a VC firm investing in them. The second of these investments is with a hedge fund. Hedge funds are financial partnerships that use pooled funds and employ different strategies to earn returns for their investors. These funds may be managed aggressively or make use of derivatives and leverage to generate higher returns. Understand, hedge fund strategies include long-short equity, market neutral, volatility arbitrage, and merger arbitrage. Again, these can be highly risky investments. And then there is the traditional private equity fund. Private equity is an alternative investment class and consists of capital that is not listed on the public exchange. Understand, private equity is composed of funds and investors that directly invest in private companies or that engage in buyouts of public companies, resulting in delisting of the public equity. Institutional and retail investors provide the capital for private equity, and the capital can be utilized to fund new technology, make acquisitions, expand working capital, and bolster and solidify a balance sheet. Private equity firms, generally speaking, invest in established companies unlike venture capital firms. Again, these can be risky investments. Lastly, in order to invest in one of these three, you're probably going to have to be an accredited investor as the government wants to make sure you're wealthy enough to sustain a loss with these investments as they are very risky.